Theoretical study of macroeconomics includes an investigation into the business cycle, unemployment, and inflation. Practical application of these concepts affects people's everyday lives. Why is economic growth important for the average person? Does the unemployment rate matter? Does inflation ultimately impact the well-being of average Americans? And what role does the government play in steering the macroeconomic ship and guiding the U.S. economy in an effort to perform as best as possible on our key measurements of economic performance: output, unemployment, and inflation, real GDP, the unemployment rate, and the CPI. Full employment domestic output. Introduced in a previous video, vitally important to review the aggregate demand, aggregate supply model. What is the purpose of this macroeconomics tool? The aggregate demand, aggregate supply model investigates what economists refer to as macroeconomic equilibrium. What's taking place with our three important variables: the level of output, aka real GDP, the unemployment rates, and the price level, typically measured by the CPI or Consumer Price Index. As pictured on this slide, the economy is operating at full employment domestic output, firing on all cylinders, all three macroeconomic variables at the desired level. The economy is growing at about 2.8%, our long-run average annual growth rate. The unemployment rate is 4%, meaning that there's only frictional and structural unemployment, no cyclical unemployment. And price level, inflation as measured by the CPI, 2%. Unfortunately, life is not perfect. Our Goldilocks scenario of macroeconomic perfection doesn't exist all the time. There can be a significant decrease in aggregate demand. Consumer spending drops because of stock market crash, housing market decline. Investment spending drops off because profitability in the outlook of firms has seriously diminished. As pictured on the board now, the economy is in a recession. Contraction of real GDP. Unemployment well above our 4% desired level. The economy is experiencing cyclical unemployment. And no upward pressure on price level. The purpose of this lecture is to examine fiscal policy and determine what, if anything, can the federal government do to assist the economy towards getting back to our full employment domestic output level, our Goldilocks perfect scenario of macroeconomic equilibrium. Likewise, there are times when aggregate demand gets excessive. An increase in spending beyond the economy's ability to produce, aka demand pull inflation, creates an increase in the price level or an increase in the CPI well above desired level. Notice how high P1 is in this macroeconomic equilibrium. Q1, not a problem. The economy is growing strong. Unemployment, not an issue. Below our 4% full employment number. But inflation of 6 or 7% leaves consumers with less purchasing power. Again, what fiscal policy options are available to the federal government to address this macroeconomic instability? In any given year, the U.S. government collects trillions of dollars in tax revenues. The two largest sources of tax revenue for the government: payroll taxes, aka Social Security taxes, and income taxes on U.S. workers. Likewise, the federal government faces trillions of dollars in expenditures: Social Security, Medicare, Medicaid, infrastructure spending on roads, bridges, education, and military spending. The federal government has a balanced budget if expenditures and revenues are equal. Assume that in a given year, the federal government collects $3.5 trillion in taxes and exactly spends $3.5 trillion on the outlays. Then the federal government has a balanced budget. Unfortunately, my friends, this is a rare occurrence. However, you will hear lots of political posturing, both from Republicans and Democrats, about their intentions of balancing the budget. If a balanced budget is a rarity, what happens when tax revenues exceed expenditures or expenditures exceed tax revenues? In any given year, if federal government outlays or spending exceeds federal government tax revenues, the U.S. federal government is experiencing a federal budget deficit. It's important to understand the deficit must be financed. The government can't just go into the basement of the White House and print $100 bills. The federal government borrows money. Most people are familiar with the term treasury bills, treasury bonds. The federal government issues debt and uses the debt to pay for spending in excess of tax revenues. There has been years when federal government tax revenues exceed spending. That is referred to as a federal budget deficit. In that case, the federal government collects more in taxes than they spend. The federal government has two choices of what to do with the surplus. They could pay down existing debt, or they could use the money for expenditures on social programs, military spending. If we take the cumulative effect of all the years the federal government had a budget deficit and subtract out the few years the federal government had a federal budget surplus, that adds up to the national debt. So the accumulation of debts versus surpluses over time. The website at the bottom of this page is an extremely informative piece of information for most U.S. citizens who should be aware of the level of debt the United States has accrued over time. This picture is a snapshot taken April 2023 of the aforementioned website from the previous slide, the U.S. debt clock. What number jumps out at you up top on the left? 31,686 billion. That is the national debt of the United States as of April 2023. Again, how did we get to that number? All the years the federal government suffered a federal budget deficit relative to the few years the federal government had a surplus. Cumulative effect, $31,686 billion. Again, how does the federal government finance the deficit and debt? By borrowing. They issue treasury notes of different durations of time, 1, 2, 5, 7, 10, 20, and 30-year treasury notes. Look where it says U.S. federal spending, it says official, $6 trillion, right below the $31 trillion mark for the national debt. And then compare that to the right where it says U.S. federal tax revenues. The difference will give us a rough estimate of this year's federal budget deficit. Because spending $6,031 billion exceeds expenditures $4,612 billion, again, the federal government will incur a federal budget deficit in the year 2023 of roughly $1.4 trillion. It is important to break down exactly who owns the national debt. The first distinction is between intergovernment holdings and debt held by the public. Notice that orange area where it says intergovernment holdings, 6.8 trillion out of the total of just over $31 trillion, or roughly 21% of the debt, is held by government agencies. One might ask, why would the government owe money to itself? And the reason is because some government agency, like Social Security Trust Fund, take in more from tax revenues than they need. They park the excess in government securities, aka treasury bonds, until they need to spend the money. So which of the government agencies own the most treasury notes, bills, and bonds? Social Security by a long shot. So Social Security, including the federal old age and survivors insurance and federal disability insurance, they held $2.71 trillion of the 6.8 trillion. And then the next largest agency was the Military Retirement Fund at 1.6 trillion. Let's break down the debt held by the public. Public debt is 24.5 trillion of the total $32.6 trillion worth of national debt. Biggest players in the public debt arena, foreign governments. Japan and China by far the biggest holders as far as foreign government ownership of public debt. This works out to be 32% of public debt. Second largest players are U.S. banks, especially the Federal Reserve. If you look at this diagram on the far left, the Federal Reserve owns about 21% or $6.1 trillion worth of public debt. The other holders of public debt, state and local governments, mutual funds, insurance companies, pension funds. So in total, America owns roughly 68% of public debt, foreign governments roughly 32% of foreign debt. Just to reiterate, it's important to distinguish when talking about the national debt, the difference between intergovernment holdings, roughly 21% of debt, and debt held by the public, the remaining 79% of the debt. Quick review, 21% of national debt held by intergovernment agencies, about 21% held by our nation's central bank, the Federal Reserve. Important to notice that number, especially when future economic lessons will discuss the importance of monetary policy and the role the central bank takes in managing the nation's economy. And 32% of the national debt is held by foreign governments, Japan and China by far the biggest players. All things in life are relative, and one measure of the national debt is to measure its size relative to the total economic output of the country, or measure national debt as a percentage of GDP. Let's start on the far left, 1900. You can observe that national debt as a percentage of GDP was a measly 3.5%, nothing to worry about. And then the United States went through a dark and dismal period known as the Great Depression. FDR became president. FDR was losing sleep about the large federal budget deficits of $15 billion per year during the Great Depression, but prior to the war. Federal budget deficit increased to over $100 billion per year during the war, and notice that national debt as a percentage of GDP skyrocketed to almost 104% during the worst military conflict mankind has ever seen. But after the war, the U.S. economy grew like gangbusters, and the national debt as a percentage of GDP declined all the way through the 70s. In the 80s, Reagan took office and decided to approach the Cold War confrontation with the Soviets with a significant military buildup. At the same time, Reaganomics cut taxes. Notice that during the 80s, national debt as a percentage of GDP began to rise. In the 90s, the United States cut back on military spending, the Cold War was over, and the economy experienced a flourish of economic activity and a near 10-year economic expansion. National debt as a percentage of GDP again began to fall. Unfortunately, in 2007, the U.S. and actually every country in the modern industrialized world endured one of the worst recessions in history, now referred to as the Great Recession. The financial collapse and the housing bubble burst. Notice that national debt as a percentage of GDP again began to climb. Who knows what would have become of national debt as a percentage of GDP if we and other countries did not have to suffer through the pandemic, but we'll never be able to answer that question. Economic conclusion: since the pandemic, U.S. national debt as a percentage of GDP is back near 100%. Another measure of deficit spending and debt is to compare federal budget deficit for 1 year relative to total economic output, or GDP. So up top on the right, we have data for 1970 through 2024, measuring the federal budget deficit as a percentage of total economic output or total GDP. Observations. From 1970 through 1996, the federal budget deficit as a percentage of GDP rarely exceeded 5%, except for those 5 years in the Reagan military buildup in the 80s. Notice that period of time in the 90s, the dot-com era, computerization and the internet were a catalyst for exceptional economic growth, and the U.S. federal government actually enjoyed federal budget surpluses. Before the Great Recession, things looked pretty good. Federal budget deficit as a percentage of GDP was a mere 1.1% the year before the economic downturn now known as the Great Recession. But the Great Recession and the cataclysmic economic downturn which ensued, federal budget deficit rose to 9.8% of total GDP, and then during the pandemic, when economic catastrophe was upon us, federal budget deficit reached 15% of GDP. This slide examines the same relationship between the federal budget deficit and total economic output or GDP, but for more recent economic history. Two important observations: the increase in the federal budget deficit as a percentage of GDP caused by the Great Recession of 2008/9, and the serious increase in the federal budget deficit caused by the economic catastrophe of the pandemic in 2020. Federal budget deficit reached 15% of GDP. The Roaring '20s was followed by the worst period in U.S. economic history, now referred to as the Great Depression. 1 in 4 Americans was unemployed. Serious contraction in economic activity. After the dust settled in World War II, 1946, the Employment Act. Congress passed a law determining that the federal government can never again allow such a catastrophic macroeconomic catastrophe to ruin the lives of average everyday Americans. It established the Council of Economic Advisors. So the council is roughly 35 individuals, and their job is to advise the executive branch or the president on economic policy. It also established the Joint Economic Committee, again, an advisory board which researches macroeconomic data and reports to and advises Congress. Long story short, the Employment Act instituted into the U.S. economy a much more prevalent federal government in the affairs of our macroeconomic well-being. Even during economic good times, when the economy is growing at or near our long-run average rate of growth of approximately 2.8% and unemployment's about 4%, inflation's about 2%, the federal government collects trillions of dollars in tax revenues, and the federal government makes trillions of dollars worth of expenditures. However, when the economy is not operating at full employment domestic output, when the economy is experiencing a downturn known as a recession, or trying to combat demand pull inflation, the government is now commissioned by the Employment Act of 1946 to take an active role in righting the ship. We're going to study what is referred to as discretionary fiscal policy. So, what does discretionary fiscal policy mean? Active changes to the level of government spending and or the level of taxes, with the specific goal of affecting aggregate demand. Remember, there will always be a high level of government spending, and there will always be a high level of taxes. Discretionary fiscal policy refers to a change in the level of government spending and or a change in the level of taxes, and it actually involves a law in which the House and the Senate, Congress, introduces a bill to the president, and the president signs that bill into law with the conscious decision to affect, or at least attempt to affect, aggregate demand in an effort to steer the ship, the U.S. economy, back towards full employment domestic output. If discretionary fiscal policy refers to active changes in either the level of government spending or the amount of tax revenue the government collects, why the aim at aggregate demand? What's the economic logic of economists stating fiscal policy is intention to affect aggregate demand? The idea is that by changing the rate of taxes collected by the government and or the amount of government spending, the government can influence aggregate demand by altering the behavior of consumers and consumer spending and gross business and the amount of gross business investment which take place. Reflecting back on our aggregate supply, aggregate demand model, we'll demonstrate how changes in either the level of taxes or the level of government spending or both will ultimately impact aggregate demand during an economic period of recession or demand pull inflation in an effort to steer the ship towards full employment domestic output. Assume this is the current state of macroeconomic equilibrium for the U.S. economy. Make some observations about GDP, unemployment, and inflation. Well, aggregate demand has shifted rather far left. Private sector spending is sluggish. Consumer spending on durable goods, weak. Gross business investment, meager. The economy has contracted. So GDP is negative relative to where we were. If the economy is faltering and GDP has contracted, unemployment is above our desired 4% full employment rate. The economy has cyclical unemployment. So let's assume that the economy has contracted 1.5%, 2%, and unemployment is now 9%. With a weak economy, price level is not the problem. Inflation might actually be below our 2%. The question is, what fiscal policy options, again, discretionary fiscal policy, can the House and the Senate, can Congress introduce a bill and have the President sign it, which affects the level of government spending and or the level of taxation with the goal of influencing or impacting aggregate demand? So this economic scenario of recession calls on the government to institute what is referred to as expansionary fiscal policy. So just the word itself, expansionary fiscal policy. In the previous slide, we witnessed or we observed weak aggregate demand. The goal of expansionary fiscal policy is to expand aggregate demand, to influence consumers and businesses to spend more in an effort to shift aggregate demand to the right. So expansionary fiscal policy involves one of three approaches. Either an increase in government spending, or tax reductions, or combination of the first two approaches. So again, recession, aggregate demand weak, consumer spending meager, investment spending, businesses have decided profitability doesn't look so positive for the foreseeable future, GDP contracting, high unemployment, price level, inflation, not a problem. What response can the government use as far as discretionary fiscal policy in an effort to steer the ship back towards full employment domestic output? One of these three approaches: increase in government spending, tax reduction, combination of both. Let's examine graphically how fiscal policy works. First, observe what's going on in the economy using the aggregate supply, aggregate demand model of macroeconomic equilibrium. As pictured here, aggregate demand has shifted pretty far left. A significant decline in consumer spending and investment spending, private sector spending, miserable or weak during a recession. Households have stopped spending on any type of discretionary items not necessary. Businesses finding few projects where expected rate of return exceeds the real rate of interest. Weak private sector spending, A decline in investment and household spending shifted the aggregate demand curve to the left. Current state of the economy, GDP has contracted. Falling GDP means we're in a recession. Recession means there's cyclical unemployment. Unemployment well above full employment output. So assume that unemployment is 9–10% as pictured on this graph. No upward pressure on prices as weak demand in the private sector for goods and services, along with weak demand by businesses for resources. No real pressure on inflation. Now the government steps in and deploys expansionary fiscal policy, fiscal stimulus. Let's first analyze government spending and its effect on aggregate demand. Assume the government spends $5 billion on infrastructure, roads and bridges. The initial increase in aggregate demand will be the $5 billion spent by the government, and then assume the multiplier effect ultimately causes a larger increase in aggregate demand. In this example, the marginal propensity to consume is 0.75, making the multiplier 4. So the initial increase in government spending of $5 billion causes an ultimate increase in aggregate demand of $20 billion. Notice the shift from AD2 towards AD1. Measured by this graph, GDP increases by a total of $20 billion from 485 to 505. What if the government, instead of using an increase in government spending, decided to cut taxes? Remember, a portion of the tax cut would be saved. So the government would need to cut taxes by $6.7 billion to achieve the same total impact on aggregate demand. If the government cuts taxes by $6.7 billion, 75%, 0.75 is the marginal propensity to consume. 75% of the tax cut would be spent, again causing an initial increase in spending of $5 billion, and the multiplier effect would ultimately have the same total impact on GDP, a $20 billion increase in aggregate outputs. Most likely the government will use a combination of tax cuts and spending. In the previous analysis, expansionary fiscal policy employed by the government to combat a recession, either an increase in government spending or a decrease in taxes, or some combination of both, had very little or any impact on price level. What does the real-world evidence suggest about this analysis? Again, assume the economy has fallen into recession, contraction in economic activity, fall in consumer spending and investment spending. Real GDP has contracted, unemployment is well above full employment. At this point, there's no upward pressure on prices, and then the government cuts taxes or increases government spending, resulting in an increase in aggregate demand to some extent, and then the multiplier effect ultimately shifting aggregate demand back towards full employment domestic outputs. The economy suffered a recession in 2000, and then the terrorist attacks of September 2001 did further damage to the economy. The Bush administration cut taxes in an effort to stimulate aggregate demand. It was not the most severe recession ever experienced by the U.S. economy, and the increase in disposable income received by Americans through the tax cuts shifted aggregate demand curve to the right. The economy recovered towards full employment output, unemployment fell, and there was some upward pressure on prices, an acceptable amount of inflation. When Barack Obama took office in 2009, the economy was in a severe economic downturn, now known as the Great Recession. The Obama administration instituted a significant expansionary fiscal stimulus, which included both government spending and tax cuts. Because the economy was in such a severe state, the expansionary fiscal stimulus instituted by the Obama administration definitely shifted aggregate demand to the right somewhat, but had very little or any impact on inflation. GDP increased some, unemployment came down little by little, but because of the severity of the recession, the expansionary fiscal stimulus was not inflationary. Review of expansionary fiscal policy. The U.S. economy has fallen into recession. GDP has contracted from previous levels. Weak economic output has caused unemployment to rise above full employment level. Cyclical unemployment is plaguing the U.S. economy. No upward pressure on prices as household consumer spending is weak. Gross business investment also has fallen. Therefore, inflation is not the problem. What can the government do, the federal government do, to assist the economy in its effort to regain its former glory of full employment domestic output? The first option is an increase in government spending. The government spends a dollar will be injected into the economy. The government spends $100 billion on infrastructure, automatically aggregate demand will shift to the right, an increase in spending to whatever level the government approves for infrastructures and other projects. The government spending will ultimately impact and increase private sector spending. As the government spends money, businesses contracted to perform the economic activities associated with infrastructure projects will receive more business. Likewise, businesses will employ more people. So any increase in government spending will ultimately have a multiplied effect on aggregate demand, shifting aggregate demand back towards the full employment level of macroeconomic equilibrium. The other option government can consider to combat a economic downturn caused by a leftward shift in aggregate demand, weak GDP and high unemployment is decreasing taxes. Cutting household taxes on income earners or increasing taxes on businesses both will have the same effect, an increase in aggregate demand. Any tax cuts will influence households to spend more and incentivize businesses to search out new projects which now look more profitable based on the tax cuts in the private sector. And again, this will have a multiplied effect on economic output. The economy has fallen into recession. Aggregate demand has shifted significantly left because of a decrease in consumer spending and investment spending. Gross domestic product is weak and negative relative to where we were a year ago. Unemployment is rising. The current unemployment rate well above 4%, the acceptable number. Cyclical unemployment plagues the economy. What can the federal government do to address the economic downturn? Expansionary fiscal policy is in order. Which approach, government spending or tax cuts, is the better option? Let's look at the numbers on line 2 here. Assume the marginal propensity to consume in the economy is 0.75 and the multiplier is 4. Remember, calculate the multiplier by taking 1 over 1 minus MPC. So if the marginal propensity to consume is 0.75, the multiplier is 4. $100 billion in government expenditures will ultimately expand GDP by $400 billion. If the government spends $100 billion on infrastructure projects such as roads, ultimately GDP will increase by $400 billion. What if the government decides, well, let's take the tax cut approach? Notice any proposed tax cut will need to be larger than any increase in government spending. Why? The marginal propensity to consume tells us only 75% of the tax cuts, the additional disposable income households receive, will be spent. 25% will be saved. So therefore, any proposed tax cut will need to be larger than any increase in government spending to have the ultimate impact on GDP. So 75% of 133 is 100. If the government cuts taxes by 133 billion, 75% of that 100 billion will be spent, and again, the government will achieve the 400 billion in total increase in GDP. Now, the ultimate question. Which approach is better? Well, better is a relative term. Left-leaning politicians, liberals, Democrats, are typically proponents of increased government spending, bigger government. Right-leaning, conservative Republicans are generally advocates of tax cuts. There are pros and cons to both approaches. We already discussed the mathematic pros of government spending relative to tax cuts. However, not all government spending is efficient, and there are plenty of examples of wasteful spending. That's one argument against using government spending as the methodology to combat an economic downturn using expansionary fiscal policy. What about the idea of tax cuts? Obviously, the tax cut needs to be larger than the increase in government spending, but back to the idea of allocative efficiency. What would you rather have for Christmas? Would you rather have someone who loves you but doesn't know your taste very well buy you a present worth $100, or give you a $100 gift card, allowing you to spend the money the way you see fit? There's definitely an argument that giving people money in the form of tax cuts will ultimately be more efficient from the standpoint of how the money is spent and the allocation of resources to generate the products and services in society most desirable, creating the most utility. Now, final point, which is very important. Whether the government cuts taxes or uses an increase in government spending, both approaches will ultimately expand the size, increase the size of the federal budget deficit. So expansionary fiscal policy increases the size of the federal budget deficit. Again, there is always a cost. You can't have something for nothing. Typically, there's going to be some agreement of increase in government spending and tax cuts used simultaneously, some degree of both approaches. But remember, expansionary fiscal policy increases the size of the deficit because government spending increases, tax receipts decrease, meaning that the relationship between revenues versus expenditures is now negative. Can't have something for nothing. Expansionary fiscal policy going to raise the size of the federal budget deficit. During a rigorous economic expansion, the economy could experience a situation where aggregate demand, total spending, exceeds the economy's ability to produce. Too much money chasing too few goods. Evaluate macroeconomic equilibrium as pictured here. Q1, P1. Economic output strong, the economy growing faster than 3%. Unemployment, not a problem. The unemployment rate's below our full employment number. So definitely no cyclical unemployment, very, very little frictional unemployment, still some structural unemployment, unemployment 3.4%. But notice that the excess of spending beyond the economy's ability to produce is having the byproduct of an unwarranted increase in price level, aka inflation. Demand pool inflation. Again, too much money chasing too few goods, spending in excess of the economy's ability to keep up with production. What can the federal government do to address this undesired increase in price level, this demand pool inflation? As described on the previous slide, demand pool inflation, too much money chasing too few goods. Assume inflation has reached 7%. What can the federal government do to address this economic worry? The appropriate fiscal policy is contractionary fiscal policy. Now remember, this is discretionary fiscal policy. Active changes to either the level of government spending or the level of taxation in an effort to impact aggregate demand. Same tools in the arsenal for the federal government in the opposite direction. If the economy is experiencing inflation well above the 2% desired level, the government wants to slow economic activity, contract aggregate spending, decrease aggregate demand. The first option is to cut government spending. A decrease in government spending will shift the aggregate demand curve to the left. The government can likewise increase taxes, taking money out of the economy. Private sector disposable income will decline, less spending power, less aggregate demand. Finally, the government could use a combination of both approaches, decreasing government spending and increasing taxes in an effort to reduce aggregate demand. Graphical analysis of contractionary fiscal policy aimed at addressing demand pull inflation. Observe macroeconomic equilibrium as pictured here. P4, inflation, 7%, well above the 2% which is considered acceptable. Too much money chasing too few goods. Notice how far right aggregate demand has shifted, and excess of spending relative to the economy's ability to produce. The government desires to rein in some of that spending, to decrease aggregate demand, to bring down this inflation, to bring down general price level. So the government can decrease government spending, increase taxes, or use some combination of both. Assuming the government uses both approaches, cutting government spending and increasing taxes, aggregate demand will shift to the left, taking some of the economic ammunition out of the economy by decreasing government spending and increasing taxes, which reduces the amount of disposable incomes households hold, will shift aggregate demand from AD4 to AD3. If successful, notice inflation falls from P4 to P3. Assume that's a decline in inflation from 7% back towards a more desirable level of 3.5%. Remember, this will be called disinflation. Still have inflation, but not as bad as the previous period. Review of contractionary fiscal policy. Remember, any discretionary fiscal policy is aimed at affecting aggregate demand. If demand pull inflation, too much money chasing too few goods, is plaguing the U.S. economy, and the government decides to decrease spending, how will that ultimately affect aggregate demand? Any decrease in government spending will shift aggregate demand curve to the left, and there'll be a multiplied effect. As money is taken out of the economy in the form of less government spending, there'll be less economic opportunity and income for both consumers and investment in the form of businesses. The multiplied effect will ultimately shift aggregate demand to the left by a significant amount, hopefully reining in some of that unwanted inflation. When demand pull inflation is the economic issue, the other option is for government to increase taxes. Increasing taxes will reduce the amount of disposable income households hold and will reduce the profits for businesses, which will lead to fewer investment opportunities, which appear to be profitable for the private sector corporations and firms. Both of these will ultimately decrease aggregate demand, again, hopefully having the desired outcome for the federal government, that is to say, a reduction in aggregate demand, which brings inflation back to a more acceptable level. If GDP is growing at a rate of better than 3% annually, and unemployment is below 4%, but price level is plaguing the economy, demand pull inflation is a macroeconomic worry, theoretically, the government could address the undesired increase in inflation by reducing government spending, increasing taxes, or using some of both approaches. In reality, politicians do not possess the political will to follow through on such policies. Have you ever heard of a politician running for office as part of their platform tell their constituents their best idea is to raise taxes? Likewise, it's not exactly popular for politicians to propose cuts in government spending, especially any cuts in government spending which would directly impact the geographic region of that politician. So in reality, contractionary fiscal policy is not a popular political option. Plus, there's generally a better tool for addressing inflation, and that is monetary policy. The Federal Reserve controls the nation's money supply and directly impacts interest rates. If inflation is an economic worry, the Federal Reserve, our nation's central bank, will react by reducing the money supply and increasing interest rates. A detailed examination of monetary policy will be performed later, but just for now, simple example, between the end of 2021 and the beginning of 2023, price level has been far above a desired level, and the Fed has responded by raising interest rates on already 7 occasions. That song by the Beach Boys, wouldn't it be nice? Wouldn't it be nice if discretionary fiscal policy was never necessary? Wouldn't it be nice if the economy had self-righting mechanism? So to some degree, there are what are referred to as built-in or automatic stabilizers already baked into the system. So automatic stabilizers, their features already built into the economic system where the level of taxation and the level of transfer payments, aka government spending, automatically adjust based on the phase of the business cycle. How do built-in stabilizers work? What do we mean by automatic stabilizing mechanisms? Without discretionary fiscal policy, without Congress introducing a bill and the president signing it into law, there are automatic adjustments to the level of government expenditures and tax receipts during economic business cycle. Tax payments automatically decline during an economic downturn. Why? Remember, individuals working pay income taxes. When the economy falls into recession, fewer members of the American workforce are employed, therefore income tax and payroll tax receipts decline for the government. Likewise, during an economic downturn, people feel less happy about their economic financial situation, spend less on discretionary items, less sales tax collected by the government. Transfer payments automatically increase during a downturn or recession. Why? One form of transfer payments, which are directly related to an economic downturn, are unemployment benefits. When members of the labor force are unfortunately told they no longer have employment, they file for benefits. Therefore, the government automatically increases this social welfare payments, so government spending automatically increases during a recession. The opposite occurs during booms, during economic good times. So if tax payments decline during an economic downturn, tax payments increase during a period of strong spending. Why is that the case? Well, tax payments would automatically increase during an economic boom because more Americans are working, more Americans paying into income and Social Security tax. Likewise, discretionary spending is strong, so more sales tax collected. Transfer payments automatically decline during an economic boom. Few Americans filing for unemployment benefits, less government spending in the form of this social welfare benefit. Now, why are these important? What is the importance of automatic or built-in stabilizers? To some degree, they reduce the shock of recessions and demand pull inflation. This graphical analysis will reinforce the importance of built-in stabilizers. On the horizontal axis, simply measuring the amount of real output, real GDP. On the vertical axis, measuring both government expenditures and tax revenues. Assume that government expenditures do not vary based on the level of output. So there's no discretionary fiscal policy in order here. Taxes will automatically adjust based on the phases of the business cycle. The purpose of this demonstration is to reinforce the idea that built-in stability has an automatic impact on the economy without Congress needing to enact a new bill and the president signing it into law. So if GDP represents full employment domestic output, what happens when GDP falls to GDP 1 during a recession? Well, automatically the government will incur a deficit. Why? Because they'll be collecting less in tax revenues and spending more on social welfare benefits of unemployment. Likewise, when GDP is extremely strong, we see this automatic surplus, or at least a reduction in the level of the deficit, as the government collects more in tax revenues because more people are working and has fewer worries about expenditures on unemployment, social welfare transfer payments. So to some degree, there's this built-in stability where the economy will automatically run deficits during a recession and automatically collect more in tax revenues during a strong economic period. So without any discretionary fiscal policy, the built-in stabilizers have this righting mechanism to combat an economic downturn and to somewhat, to some degree, address demand pull inflation. Final thoughts about automatic stabilizers and the role of built-in stability for managing macroeconomic instability and upswings and downswings. The United States operates on what is referred to as a progressive tax system. The most recent tax brackets are provided below. These are from the IRS. Notice that as an individual earns more income, they pay more progressively in taxes. So progressive tax system, an individual making $100,000 doesn't pay 24% on all 100,000. It's a marginal system. As the income increases, your tax burden increases. There is a correlation between progressive tax system and the amount of built-in stability in the macroeconomic system. If the government were to increase marginal tax rates, there would undoubtedly be a larger degree of built-in stabilizing. However, there are trade-offs like all other economic events, choices, trade-offs, and costs. What's the trade-off of a more progressive tax system? Currently, the highest income earners have a marginal tax rate of 37%. Some people argue we should increase the marginal tax rate on high income earners. Evidence suggests increasing marginal tax rates slows economic growth. So there's a trade-off between slower economic growth and more stability to be garnered from higher progressive tax rates. As they say, there is nothing perfect in life. Yes, fiscal policy has its criticisms, problems, and complications. We're going to be exclusively looking at expansionary fiscal policy, which is increasing government spending and/or tax cuts used at stimulating the economy during an economic downturn. So assume the economy has fallen into recession, contracting GDP, rising unemployment. What can the government do in terms of discretionary fiscal policy to impact the economy to alleviate the suffering? Well, one criticism of using tax cuts and government spending to address an economic downturn is referred to as the problem of timing. It may take a while for those in Washington to recognize the economy has actually contracted to the point where we need expansionary fiscal stimulus. Now, the 2007 financial crisis and housing bubble burst and the pandemic were blatantly obvious economic catastrophes. The recognition lag did not apply in that situation. In 1991, the economy suffered a more mild and a different type of recession. It was actually more of a white-collar recession, so there could be some recognition lag. The next issue about timing is administrative lag. There's an old joke about it takes politicians in Washington an hour and a half to watch 60 Minutes. The Democrats and Republicans don't agree on much, but over the past 20 years, they've agreed on less and less. Remember, the left is typically big proponents of more government spending. The right are usually advocates of tax cuts. There's going to be some quibbling and some quarreling about what approach is the best to use to address the economic downturn, whether it be government spending or tax cuts. Speaking of government spending, there's also this issue called the operational lag. Assume the government agrees to repair or replace bridges at various states across the country. The money was approved yesterday, but it may be 2 years until the pavement actually receives the payment. In other words, environmental studies and all kinds of legal issues could hold up the spending between when it's approved and when it makes its way into the economy. So these three issues are referred to as the problem of timing as far as expansionary fiscal policy. Political considerations. What are politicians in business to do? What do they care most about? That's right, getting reelected. So there is evidence that in the past, politicians have used government spending and or tax cuts to make the economy appear better during an election year. So to improve their re-election outlook or possibility, politicians could cut taxes or increase spending in an effort to fulfill their own desire to be re-elected. Future policy reversals. Remember, tax cuts are temporary during a downturn. Increasing government spending won't last. Households plan their budgets for a year and sometimes further. So if households don't believe that tax cuts will be permanent, any increase in disposable income received in the form of a tax cut may not have the impact desired by the government because households will save the money under the assumption that it's a one and done decision and there will not be any more tax reductions in the future. Likewise, businesses make long-term plans, and if they believe some government policy will only be in place for a temporary measure, it is unlikely to affect their long-run investment horizon decisions. Offsetting state and local finance. The federal government has the luxury of running deficits during an economic downturn to finance tax cuts and increasing government spending. State governments do not have that same luxury. So many states, by their charter, are mandated to have a balanced budget. So we have this yin and yang. Think of a tug of war. The federal government is cutting taxes and increasing government spending in an effort to stimulate economic activity. The federal government wants aggregate demand to shift to the right, so they're putting more disposable income in people's pockets with tax cuts, and they are increasing government spending to increase economic activity. At the same time, state governments are looking for ways to cut budgets. Now, outright tax cuts might be unpopular in states, but they will also encourage ways for government agencies to collect more. So for instance, encourage police officers to write more tickets. States are cutting back on spending. Federal government is increasing spending. Ultimately, the federal government wins out, but the effect of fiscal stimulus, of expansionary fiscal policy, isn't as great as could be based on this offsetting finance between local government and federal government. The crowding out effect. This one is quite involved. We will examine this crowding out effect in more detail next. Quick review of a concept covered in a previous video, which will be extremely relevant to analyzing the crowding out effect as a criticism of expansionary fiscal policy. This is a graph of the domestic money market. What is being graphed on each axis? On the horizontal axis, we have the quantity of money demanded and supplied. On the vertical axis, it's not the price of money, it's the interest rate. I've already spoken in detail about the importance of interest rate and how interest rate influences gross business investment. Lower interest rates stimulate investment as businesses find it easier to find projects where the expected rate of return exceeds the real rate of interest. And lower interest rates also incentivize households to borrow and spend on big ticket items like homes and automobiles. Notice that the supply of money is vertical. At any point in time, the money supply is fixed. The supply of money is controlled by the Federal Reserve, the U.S. central bank. The demand for money. Every time an economic transaction takes place, money is necessary to facilitate that transaction. Given a certain demand for money and a certain supply of money, we have equilibrium in the money market. Let's focus on I1, interest rate 1. Assume that is 4% interest. Notice any factor, any event, any economic circumstance which increases the demand for money will increase the domestic interest rate. In this example, a shift of the demand for money, upward increase, rightward shift of the demand for money, increases the interest rate from 4% to 6%. Let's evaluate the criticism of expansionary fiscal policy known as the crowding out effect step by step. First, the economy has fallen into a recession. A decline in consumer expenditures and gross business investment, weak private sector spending leads to a decline in real output. Real GDP is declining, which means unemployment is rising well above our 4%. Cyclical unemployment plagues the economy. Weak consumer spending and lackluster gross business investment, no upward pressure on price level. At the moment, inflation is not a problem. In response to the weak economy and the recession, Congress and the President pass discretionary fiscal stimulus. They use expansionary fiscal policy to address the declining GDP and rising unemployment. So let's assume that the government uses a little bit of both medicine. The government increases government spending and implements some tax reductions to shift aggregate demand to the right to increase total amount of spending in the economy in an attempt to right the ship, get aggregate demand back towards full employment domestic output. Both approaches, increasing government spending and reducing taxes, will have the same effect on the federal budget. The government spending more and collecting less in taxes will lead to a larger federal budget deficit. How does this impact interest rates? To finance that deficit, the government needs to borrow. So the government increases the demand for money when the government issues debt, treasury securities, bonds to finance deficit spending. The increase in the demand for money increases interest rates. Now the conclusion, the crowding out effect. Government efforts to combat a recession using expansionary fiscal policy means higher interest rates, and higher interest rates may crowd out some private spending, some private investment. Businesses may find it difficult to find projects where the expected rate of return is greater than the real rate of interest, and it will discourage some homeowners from borrowing to finance cars and other big ticket items. Now, in the short run, the nation's central bank, our Federal Reserve, can respond by increasing the money supply to negate this crowding out effect. However, the crowding out effect is becoming worrisome in the long run. As discussed earlier in this caption video, the U.S. national debt has now surpassed $32 trillion. There is a possibility that continued borrowing and large deficits, continued increase in the demand for money to finance these deficits, could push up interest rates, and in the long run, the crowding out effect negates what would be otherwise profitable opportunities in the private sector when businesses borrow to invest in new projects. $31.6 trillion sounds like a boatload of money, and indeed it is a lot of debt. Is the national debt a looming crisis? Let's investigate this issue and dispel some of the false concerns on this politically charged debate. Number one, is there a possibility that the federal government would go bankrupt? This is highly unlikely for two reasons. First, the federal government possesses the ability to refinance existing debt. That is to say, to issue new government bonds to retire existing debt. The demand for government securities, aka treasury bonds, is enormous. Government debt issued by the U.S. federal government is considered the safest financial instrument on earth. As long as there is significant demand for U.S. government debt, it's highly unlikely that the federal government would not be able to refinance the existing debt. Second, the federal government has the power of the tax lever, and taxes could be increased if and when it's necessary to increase the amount of revenues collected by the government. Second worry, the national debt will present a burden to future generations. A little bit of math. 71% of all national debt is owned by the U.S. In other words, we owe money to ourselves. So, in essence, the interest payments made on government bonds, 71% of those accrues to American citizens and institutions. The World War II example helps pacify some of these concerns. In World War II, what happened? Well, national debt as a percentage of GDP skyrocketed to over 100% of aggregate output. But in essence, the citizens of that era made a trade-off between consumption and military output. They paid the price with foregoing present consumption of civilian outputs to produce the war military output necessary to win the conflict. And future generations who inherited the government bonds issued during that time ultimately received the interest payments and the financial reward for those bonds. Number three, income distribution. This is a significant concern. Most of the government bonds, treasury securities, are owned by well-to-do and wealthy Americans. Low-income earners do not own a large percentage of that 71% of government debt owned by Americans. So in some way, the national debt does add to income inequality concerns in the United States. Interest on the national debt. Currently, interest payments on national debt. So all those bonds were issued. By law, the federal government must make those interest payments. Interest on national debt now represents 12% of all federal spending. Excellent example of opportunity cost. The 12% of federal expenditures necessary to finance national debt cannot be used for any other social services, and therefore there is a significant opportunity cost associated with the rising debt and the interest payments which must be made. The last concern is somewhat alarming. Foreign ownership of debt, 29%. Yes, in some ways we are transferring wealth from the U.S. to other countries. However, it is important to identify that Americans own debt issued by other foreign governments as well, and although it's not a perfect wash, it is almost a tit-for-tat relationship between the amount of money sent in interest payments to foreign governments relative to the amount of interest payments collected by Americans who own debt issued by other countries. Again, all things are relative. Good to have some international comparison and identify where the United States stands relative to our modern industrialized peers. So in 2005, U.S. national debt as a percentage of GDP was a mere 45.7%. Italy had a much higher concern at 101% of their total aggregate output. At this point, Japan was slightly less than 81% of their national debt relative to GDP. Fast forward to 2017, Japan, 240%. That is to say, their national debt now represents 2.4% or 240% of their gross domestic output. In 2017, the United States was still in relatively decent shape, although national debt as a percentage of GDP had increased from 47% to 80%. That was all because of the Great Recession and the massive expansionary fiscal policy and the stimulus necessary to address that economic downturn. Economic events create secondary effects. The last slide observed national debt as a percentage of GDP in 2017 and the effects of the Great Recession, the financial crisis. Now we observe national debt as a percentage of GDP in 2021 after modern industrialized nations had to respond to the pandemic downturn with massive fiscal stimulus and expansionary fiscal policy to keep their economies from falling into the abyss. At this point, the United States national debt as a percentage of GDP had risen to just over 127% of aggregate output. Notice that most modern industrialized nations now have a debt level, national debt relative to GDP, of greater than 100%. And again, this is in response to the pandemic. The Bureau of Economic Analysis, the Bureau of Labor and Statistics, the Federal Reserve, economists, and business women and men, all interested in making some prognostication of where the economy is headed, what is the future state of macroeconomics, how will GDP, unemployment, and inflation look a week, a month, a year down the road. The leading economic indicators give some indication of where the economy is headed. Understanding this is as much art as it is science. What are the statistics analyzed by these pundits? Average hour of work week is an important indicator. More hours means more likely the economy is improving, and vice versa. Initial jobless claims. If more people are filing for unemployment benefits, that's a bad sign. Consumer good orders, especially for durable goods. Durable goods tend to cost more and last longer, and therefore are big drivers of the business cycle. Vendor performances. Many companies simply serve other companies as suppliers. When these companies are performing well, it's a positive economic indicator, and vice versa. Capital goods, machines, equipment, tools, factories have already reiterated the importance of new orders for capital goods. The housing industry is a driver of economic force in this USA nation, so building permits for houses is an important indicator to be watched. The overall stock prices, the indexes most watch are the NASDAQ and the Dow Jones Industrial Average, but probably most important, the S&P 500. The supply of money, or the stock of money in the economy, a growing supply of money typically facilitates more economic activity, and vice versa. The interest rate spread. The interest rate on a 2-year Treasury note versus a 10-year Treasury note. This one is quite involved, but long story short, there is a factor known as the yield curve, which pundits often observe and analyze pretty closely. If the interest rate on a 2-year Treasury exceeds the interest rate on a 10-year Treasury, the yield curve has inverted, and this is typically a bad sign for the economy. Most recessions are preceded by an inverted yield curve. And finally, consumer expectations. That is to say, with the Michigan study, how do the average Americans feel about their financial and economic well-being? Take it a step further. Real-world observations. What is the deal with recessions? Are they inevitable? These two videos do an excellent job of, number one, explaining who does the heavy lifting when it comes to determining when and if the economy is in a recession. That's the first video offered by the Wall Street Journal. And the second, a CNBC offering Are recessions an inevitable part of the business cycle? Students are strongly encouraged to visit both of these videos and use them as a catalyst to increase the learning opportunity of macroeconomics.